Welcome to TheoTRADE. This is Don Kaufman. It's August 30th, 2023. We are just seconds after the cash close here on this Wednesday afternoon. S&P is trading, well, mildly higher. But think for just a second about why markets are higher the last few trading sessions. I mean, specifically yesterday's just absolutely ripping rally on what? On the backbone, literally, of what? Of bad data. Which brings us, of course, to tonight's topic for the TheoTRADE video. Should bad data rally markets? Let's get right down to business here in this evening's video. One of the first things, again, we want to recognize is it's not just one or two, if you will, bad data points. What I'm referencing in terms of data points, we had a JOLTS number, which is kind of what they call the take this job and shove it. It was way off. We had a consumer confidence number, was way off. Obviously, some of the Chinese data has just been way off. Okay. We had GDP, the revised GDP came out this morning, way off in terms of the revision. That one was really big. It was a revision down like by 0.3%. They couldn't hit the broadside of a barn, okay, with that last data point in GDP. And later this week, we're going to have non-farm payrolls, the employment situation. At some point in this marketplace, bad might be construed as bad once again when the marketplace recognizes the Fed may actually not step in and save the world for the 50th time in here. And that is why in the coming days, if we start getting more data points that are going to be negative, and again, there's a lot of catalysts. Like, let's not even talk about like what the JOLTS number is. Don't even worry about what non-farm payroll, like forget it. We're supposed to create X number of jobs. Doesn't matter. Doesn't make a difference. Every single one of these announcements coming out, okay, just view it as they're lighting a fuse, okay? They're lighting a fuse, and at some point, bad becomes bad again and needs to be, right? So when I'm talking about different data points that are coming out again, like later this week, you got the employment situation, obviously. I know everybody wants to look, we're expecting this and we're getting this, and forget it. It's all for nothing. You know, the new GDP, because we just revised really bad GDP. Do we even trust the GDP? Because they just revised GDP from 2.4% down to 2.1% for Q2, which is just a huge miss. Okay. I mean, there's construction spending, there's ISM, there's Chicago PMI. Okay. How many fuses can we possibly get lit in the next couple of days? And again, you know, should bad data be rallying markets? Because the assumption is very simplistic, you know, in its ideal. In fact, I'm going to come back here and go to a 30-day 1 hour and just bring up, okay, what turned into on Tuesday is just an absolutely explosive rally to the upside. Again, you just keep in mind it was an explosive rally, like, yeah, the economy is drifting rapidly into recession, you know, and everybody's like, yes, that means probably that the Fed either isn't going to hike again. Okay, think about how ridiculous this is, that the Fed either, number one, isn't going to hike, okay, possibly disinflation coming, which is never a good thing, but there's a reality in it, and that reality could be a breaking point for markets where all of a sudden bad data becomes bad again. And I, for one, have the opinion, you know, should markets be rallying on bad data? And it's unequivocally no. That bad data is going to be bad because the Fed, I don't think they're going to come to the rescue. And again, that's the opinion piece for this evening. Now, let's get down to business, though, and show you some of the price action in the markets and a little bit about at least what I'm doing in markets right now. Okay, one of the first things to display to you is, you know, obviously, and I'm going to use the spiders for this. Okay, obviously, we've had a fairly, you know, significant rally, a precipitous sell-off, followed by a nice bid back to the marketplace. All right, from here on out, no question, I think we still see some two-sided trade, right? This, to me, okay, and again, you know, this is, you know, what you're here to listen to, but this to me right now is just a bid back. it's obviously some short covering. There's no question. Short covering can take us even higher than we presently are. But right now, okay, it's a bid back, and it got a little crazy yesterday. But that's why I said I'm paying very careful attention to not what these data points are going to be later in the week, but all of a sudden when bad data becomes bad again, you know, God forbid you have a good data point, like the jobs number comes out strong. Would they crush the markets on that? There's a lot of questions. Okay. And again, what you have to recognize is you just have a marketplace that's a constant lit fuse and ready to blow. So at this point, I assume that this is just a bid back and we're still going to get some heavy volatility in two-sided trade. You know, you wouldn't know it though by the feel of today. Today's marketplace, I mean, literally, we rallied, we faded hard, we rallied back. Okay, it's just a very inside day. Inside day implies, like, again, not a lot of wild and woolly movement per se in the marketplace. And the S&Ps, okay, the volume light and fluffy with a side order of cheese. There's like just not a lot going on in today's trade. However, that being stated, if you look at the S&Ps and only looked at the S&Ps, it's not going to tell you enough. Okay, why do I still see significant ability, if you will, for volatility? Number one, earlier today, we actually saw still high degrees of correlation. Yes, we closed in what I would term a sloptastic state, but earlier in the day, there were advanced decline line to the S&P 100. We had as many as like 86 to 87 stocks trading to the upside, which implies that we still have some decent, if you will, and two-sided trade to the marketplace. But again, I'm not just going to look at one thing. I'm not just going to look at the S&Ps. The other aspect, and this is probably one of the larger ones to me, the bond market, okay, is at this point largely destabilized. And largely destabilized. If you see the heavy volume here, okay, pay no attention to the heavy volume. There's a roll going on inside of the bond market. That roll is effectively over. Nevertheless, okay, the point being, when I say that the bonds have been destabilized, clearly the bonds have had some wicked sell side. They're on a bid back. This bid back clearly is going to lower, okay, some of the yields. And when I say that bonds are destabilized, look, if the bonds continue to rally, it's lower rates, like you're thinking, oh, that's going to be a good thing for the marketplace, okay, but it's not. When they start to rally, it's possibly a rotation. If the bonds start to rally, it could be a rotation out of the S&Ps into the bond market. That's something I was actually covering on the weekend update. So the bonds, and if they turn around and sell back off, that's rates higher. Again, it's the bonds along with all of these catalysts that just, they have cracked the market, as I said, wide open into degrees of volatility, right? Next aspect, I have noticed a significant, okay, and almost like, you know, trade in terms of autonomy in most of the tech stocks. It's kind of uncomfortable because what I'm referencing here is the advanced decline line was pegged pretty much earlier today with a very strong advanced decline line, high degrees of correlation. But one of the things that's very much a destabilizing factor to this marketplace is you're getting big tech stocks that are wildly divergent, unusually divergent, and the order flow seemingly is coming out of nowhere. We are not, okay, out of the woods yet in terms of big tech diverging. There's no question that tech is what got us to S&Ps at 4,500. I mean, tech is what got us to the S&Ps anywhere this year. You know, something I've continually reiterated day in and day out. Financials are flat on the year. Literally, they're flat on the year. Now, I think that the energy sector is up 5%. There it is, good for 5%. It's all about tech. And as I just said a moment ago, tech, okay, you know, here's Tesla, it's up 137%. You know, Meta, it's up 137%. Nvidia, it's up 240%. It's almost laughable. And when it comes to something like Nvidia, you know, you're a session removed here from, it's an all-time high. It's an all-time closing high today. It's again all-time high intraday. Obviously was last Thursday before a wild reversal, but you keep eyes on this because it wasn't an easy day in Nvidia. It wasn't an up day in Nvidia. It stabilized throughout the course of the day. But one of the factors, especially if you're an intraday trader, you really got to pay attention now. Again, you trade S&Ps, you trade Nasdaq, doesn't matter. You got to pay attention to these big tech stocks. They almost feel like they're trading on autonomy, and it's not just unusual, it's incredibly unusual for a product to all of a sudden, order flow comes piling in seemingly out of nowhere. And it's almost felt like coordinated attacks into some of these products. We'll watch very, very carefully in the days to come, because this, especially in a heavily correlated marketplace, can lead to wild intraday reversals. And again, I want to reiterate that notion of volatility has absolutely, in my mind, not dissipated. That right now, okay, you are seeing the hallmark of volatility, which is the quintessential rip your face off rally. Last thing I want to mention here this evening is SPX. SPX. And why you got to mention the SPX? Of course, because it's all about what we term expected move. So this week, the SPX, which is right here, the expected, move is 66.85. Where are we right now? We are outside the upper edge of the expected move. So in any given week, look, you're expecting this, $67 move, which is to right up here. When I say here, let me give you a specific data point with that. It's roughly 44.73 in the SPX, right? So if you want, the upper edge is 44.73. The highest probability for trade at the end of the week is always to come back inside of the expected move. It doesn't have to happen that way. One thing that I've pointed out extensively in recent weeks, we are starting to see breaches of expected move here, okay? We have learned that consecutive breaches of expected move lead to, if you will, more breaches of expected move. That markets, effectively go through periods of sustained efficiency and then move into periods of rather inefficient markets where they don't adhere necessarily to expected move. And we're seeing more of that. And again, it's one of those, if you're looking for the sign of volatility, this is it. Okay, for the remainder of the week, there's no question that we're positioned, to end the week substantially higher. Okay, nevertheless, you got to think about, number one, the probability of a pullback into, of course, the edge of the expected move. By the way, I have a butterfly laid right on the edge of that expected move. My butterfly is in the none other than the SPX. So when I say I have a butterfly position, I have a butterfly position for the Friday expiration in some size, literally laying right around that 44.70 strike for a pullback to the edge of the upper edge, if you will, of the expected move. Nevertheless, it's okay if we don't get it. It was, a whopping 45 cent trade. The remainder of this week, you have to recognize we're destabilized. To go higher over here, we can see some reversals. I believe that we're going to see the upper edge of this expected move again and come into play. Expect much more considerable volatility. Today obviously didn't do it for anybody. It was listlessly higher today, again with a side order of absolutely nothing, but anticipate some more volatility coming into the remainder of this week, Thursday, Friday, not just because we're going to have catalysts and non-farm payrolls, because this marketplace, it's not going to go quietly into the night. Look for bonds actually to stage the move for the S&Ps. All right, that's it for this evening's video. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.